Okay, welcome everybody to episode 102 of the Volatility Barometer podcast. So, full disclosure, I actually decided to do this live stream maybe an hour before the markets opened. It wasn't planned at all. We usually do our Friday episode. And it just seemed like it was going to be one of those big green days. I looked at the pre-market. It was up over 1%. And whenever you get these really nasty market crashes, like it's been pretty awful for a couple weeks here, typically when people see that first green day, they, not everybody, but some people just have that need to just rush in and just pile into the short vol trade. And so I thought, you know what, I should probably do a live stream and just maybe talk a few people off the ledge, so to speak. And wouldn't you know it, the market basically gave all of it back, and it was actually negative there for a few minutes. So it didn't completely negate what I'm going to talk about, but, I'm still going to present it as if, it is definitely useful information. But, it wasn't quite the big green day I think a lot of people were looking for. And to be perfectly honest, early on, it's looking like it might recover a little. But if the market doesn't open green today, I think it could be trouble because there's a lot of people waiting for that one. And, it is what it is. So we're going to talk about a few things. I'm going to go down a list of, 4 or 5 styles of shorting volatility. If you are that type of person that thinks that now is the time to start dipping a toe. And none of this is trade recommendations. Of course, we're just talking through things, but there aren't that many places people can go to ask questions. And if nothing else, last week's live stream, there was way more questions than I had time to answer. So perhaps today we will treat it mostly just as an open Q&A. So feel free to get your questions in the chat now, and I will get to as many of them as I can later. One last thing. Last week, few people pointed out that there was something to do with the audio issues. It seemed to build up later in the stream. I've checked everything. This is all like my normal setup. I don't know what to do. So if there is some audio issues, I do apologize for that. But yeah, let's just get into the first and only segment today. So the first thing that I always want to talk about before we get into the actual trades is piling back into the market is typically not a very good idea. What I always say is you should wait for confirmation of the signal. And essentially what that means is, in every market crash, there's going to be strong corrections. There's going to be really large bounces that appear to be the bottom. And maybe they are. Sometimes it turns out to be the case. But you have to understand that when you're in the heart of one of these crashes and the volatility has spiked up, it's a really short distance from bad to worse. So if something were to happen later in the day or tomorrow or maybe over the weekend, there could be another leg down and it could get significant. So I just always like to warn people about a few best practices before actually taking these trades. And the first one that I will remind people of, I'm just going to play it in short clips just so that it's directly straight to the point. But remember to stretch out your trades a little bit longer than perhaps you would have. Tip number 1 is duration is your friend. Look, everybody already knows that when volatility spikes up like it has, there's no doubt that eventually it's going to come back down. If you're talking about the VIX, then absolutely, we will see normal levels in the teens at some point. If you're talking about volatility products, VXX, UVXY, same thing here. Of course, at some point, their long-term decay factor will pull them back down. But always remember that when you're trading volatility, being early is the same thing as being wrong. If you open a 1-month option, for example, but this market crash lingers a little while, well, eventually you'd be right on the direction, but you will have run out of time. It's still going to be a losing trade. So if you're trading options, I would always recommend that you do go about 2 to 3 months out on those expirations. Give the market some time to settle back down. And sure, the potential profit might be a little lower if you do that, but the probability of success will be much higher, and that is what we care about the most. So yeah, for my examples today, I will probably be talking about more in the just over 1 month range. But of course, don't be afraid to stretch that out a couple of months, especially if you're a newer trader, right? If you've got a certain strategy that you've always employed during these situations, then who am I to tell you otherwise? But a lot of newer traders, we all hear the risk reward ratio. A lot of newer traders favor the reward side and they forget that risk side. So I would say one of the best ways to de-risk your trade and to increase the probability of success would be to just stretch out that duration. So that would be my first and biggest tip. Tip number 2, keep your allocation sizes small. Look, I know when you see an opportunity like this, there is always going to be that temptation to just slide all your chips across the table and go big on a short vol trade. Maybe you've got that FOMO. You're scared that if you miss this opportunity, you're going to have to wait another year to get another one. The thing is, though, all market crashes have different characteristics. Sometimes they really do flash up and then come right back down. Other times, there's another leg down coming. Maybe over the weekend, things will get worse again. And don't ever forget that eventually the market will actually have an extended recession. That could easily freeze out your big short vol trade. Remember, it took the S&P 500 many years to recover from the financial crisis. And back to the dot-com bust, it took over 15 years to see the market recover. So do I think this is the big one? Well, honestly, probably not. I think the market will most likely recover here. But am I sliding all my chips to the middle on this one? No, absolutely not. There's nothing wrong with taking some trades, but definitely keep them small. Trust me, I've been doing this for almost 20 years, and there is always another opportunity on the horizon. You don't have to swing at every pitch. And one of the things that I will say that sometimes causes people to over-allocate to individual trades is just the simple fact that they don't have that many strategies that they can go to. So, for example, for me personally, I'm trading the full VTS portfolio, which is 4 different strategies, plus about 10 different option strategies that I employ. And then I also just do some sort of one-off stuff and something what I call my lotto ticket strategy, where I just see an opportunity that's just a very rare thing and jump into that. So for me, I've already divided my capital among, 15 or more different types of strategies with different assets and different exposure to the market. So it's, to over allocate to anything, for me personally, I don't have the capital available. But a lot of traders, they might be sitting on 2 or 3 trades only. And then it's very tempting for them to go short vol with like 20 or 30% of their capital. So I would always say that just be very careful in times like this. You might think today, this is the moment, like you've got to get in there and go. But like I said in that clip, there's going to be plenty of opportunities in the future. They're coming all the time. Once you start actually building multiple strategies, you will see opportunities everywhere, and you certainly do not have to just slide your chips in on each one of them. And tip number 3, this is a big one that requires discipline, but only trade instruments that you fully understand. I can't tell you how many emails I've gotten this week with people asking for feedback on their trading ideas. What about shorting the UVXY? What about a calendar on the VIX futures? What about one of the cool sounding option spreads like butterflies, diagonals, iron condors? Sure, great. All of those can work under certain market conditions. But do you even know what those things are? I'm not trying to be rude. I'm not going to put anyone on blast here, but there were several of those emails where it didn't take more than a couple back and forth to realize that the person didn't really know what they were talking about. That can be extremely dangerous in an unpredictable, fast-moving market. Don't trade volatility products if you don't know what causes their price movements. And definitely don't trade them if you don't know the risks involved and how high they can actually spike. Don't trade complex option spreads that you don't have a lot of previous experience with. When the market is changing direction really fast, it's down one day and then it's up the next. Those option prices can also swing wildly. You don't want to get caught holding something and then say, well, okay, so essentially that brings us to where we are now. Now let's just check in with this market. I haven't looked in a few minutes, but let's see what's going on. So up 0.58%. It was looking pretty sketchy there for a while. Like I said, it opened up strong. I just spur of the moment decided to do a live stream. And then by the time I sent my daily email today, the market was down. So we'll see. We'll see. I do think this is quite an important pivotal day. But let's actually start talking about some strategies. So these are typically just for me. This is not really visually for you. It's just for me to kind of keep up with my presentation here. So we're kind of going from worst to best here. And of course, there's going to be others. This is not a cumulative list of every way to short volatility. There's just going to be 5 or 6 here that I just want to mention a few things. Again, if you've got your trade in your mind, I'm not here to sway you in a different way. I just think it's a good idea to just sit back, grab a coffee, and just listen to somebody else present a little bit of data. And it might sort of sway you in certain directions. It might help you manage your risk a little bit. So, of course, everybody who follows my live streams knows what I'm going to say. The worst way to do this would be to just go in there and short naked calls. This is always a terrible idea. Now, a lot of people, there's a couple of reasons why shorting naked calls are bad. And the risk is obvious elephant in the room. It can be insanely risky. You can lose a fortune extremely quickly. But I do want to draw attention to the other major reason why people just shouldn't ever do this. And it's because it's just insanely capital intensive. You get in there with your trade and you can really only open a very small position and it's already tying up a lot of capital. So even if, and I always say this, even if you never blew up your account and you traded naked calls for 10 years and it was totally fine and you managed your risk, you're still getting a low rate of return because you're just inefficient with your capital. So don't always assume that it's because of the risk. That is an obvious factor, but also consider the fact that whenever you're trading, you also want to maximize the amount of money that you're able to put into your trades and manage the risk effectively. Naked calls violates pretty much every aspect of that. But I also want to remind people just very quickly, this is the VIX index. We're really only in about the 80th percentile. Things have not really gotten that bad. I know people look at this and they're like, oh my God, this is insane. We're certainly going to bounce and we have to get in there and we have to short everything. Well, I mean, take it easy, right? We're only in about the 80th percentile. I'm not suggesting it is going to go to 82, but it could. I mean, technically speaking, we are probably long overdue for an extended recession. So you never know. But this is the VIX long term. And you can see, I mean, we're just over 20. That's basically average. The long-term mean is 20. We're only 4 points above that. And I do want to remind people, hopefully your eyeballs are going here. A lot of people think that, oh, the VIX can't go over 100. Well, there's no ceiling for the VIX. It is just a calculation. It's just a statistic. But please remember that if we were to use the old VXO going back before the VIX index launched, this is using the S&P 100, on Black Monday, 1987, it did go to 172 intraday. So that is, I mean, I'm not suggesting it's going to happen again. The markets are a little bit different now, but just remember that that can technically happen. And a lot of people might think, oh, well, it just flashed that quickly. No, it stayed well over 100 for over a week. So just remember when you're shorting naked calls, not only is it insanely risky, but it's also extremely capital inefficient. So probably scratch that one off your list. Number 2, somewhat similar here, but I do have to mention it. Short VXX and UVXY, like the volatility ETPs, for example. Again, insanely risky. We haven't seen a whole lot of trouble yet. Even though it feels bad so far, we're barely getting started. You can see I highlighted all 4 here. These are the largest VXX spikes since VIX futures launched in 2004. 4 of them happened last year. And I don't know about you guys. I mean, everybody makes their own call, but I would not be surprised if 2025 saw at least a couple volatility spikes that rivaled last year. It's not difficult to make a case that this year could be a little bit rocky. I'm not predicting doom and gloom, but let's be serious. We're barely getting started here. So again, if you're in there shorting the VXX or the UVXY, you got to understand that it has already spiked well over 1,000%. It can go up 1,500%. Even if you were to allocate, say, 5% of your account to a short UVXY trade and you were using the ETFs, that can wipe out your entire portfolio. Not just the 5%, all of it, the whole 100, right? Unlimited loss. It could go up 20 times and you would lose your entire portfolio. So there's that. Plus, of course, I want to draw attention really quickly to something else people don't consider, but borrow rates, extremely expensive, right? So the VXX is fairly reasonable, between 3 and 4%. But when you get into the UVXY, not only can it go very high, but it can spike really high. So it seems right now it's about 10, but it can easily go to 20 or 30%. And then you're talking about if you want to go really crazy to the UVIX, this thing, you can see it spiked. It's up over 20% now. So again, borrow fees are a problem as well. There's many reasons why people should not be doing this. And few people probably haven't seen this, but it's a clip that gets right to the point. I will explain there's other reasons why you shouldn't do this as well. I don't ever short the volatility ETPs directly. First, there's big fees involved because you're borrowing shares to short, and it's not cheap. This is many multiples more expensive than standard trade fees for some of the other option trades, so this is always a major headwind. Second, they're not always available to borrow. You might think you've got a great trade setup that you want to jump in on, but if there's no shares to borrow, then what does it matter? Third, you can have your shares called away on you at any time, so you're not really in control of your own trade. Plus, you should know that the time where they are most likely to get called away on you is when you least want them to be. Probably it's going to be when you're doing damage control on a trade that isn't going well, and you might want a little extra time to fix your trade, but you're not going to be able to because the shares get called away on you. And lastly, and probably the biggest reason here, when you short shares, you have unlimited loss. We're talking about volatility ETFs here. They can spike up hundreds of percent, maybe 1,500, 2,000% if you're talking about the UVXY. Why on earth would anybody trade unlimited loss when one flash crash will wipe out your portfolio? Okay, so hopefully I have done a good job convincing a few of you, maybe people who are relatively new that have not traded through crisis. This is something that I put up on Twitter recently. You can see my Twitter account. I still call it Twitter. I'm not calling it X. At Volatility VIX, you can follow me on Twitter. But I basically said, you got to understand that the vast majority of investors, just the way that it churns with people's age and people jumping into the market, the vast majority of people have never actually traded through an extended crisis. The best they ever got was perhaps the pandemic, but even then, I don't even really count that because, they came in with multiple trillions of dollars and just V-bottomed the market. That was not difficult, right? So honestly, just naked shorts, unlimited loss, terrible capital efficiency. You can get your shares called away on you. Just consider it a no matter who you follow on Twitter or what they say. It's just not a smart way to trade. The third one, and this is going to be very common, and I know a lot of people are thinking, oh, I was going to do that. Long VIX put options or long VXX put options, kind of the same thing, right? So VIX spikes up. People think, well, I want to short volatility. One of the first things that they think in their head, well, I'll just buy a bunch of put options, right? That's a good idea. The one thing that you want to consider, and I'm not saying that it couldn't work, but you have to remember that volatility is a component in options, right? By very definition, we call it Vega. Vega measures the sensitivity of an option with respect to volatility. So what ends up happening with long put options is even if you get the direction right, because you're buying into it with what we would call a big Vega headwind, right? That contract is going to be extremely expensive. Because right now, volatility is, the premiums are high, and you're paying that to buy a put option. So even if you get the direction right, and the VIX does go back down to 20 or 18, and you called it perfectly, that premium gets sucked out of the contract as well when volatility declines, and you end up making far less than you expected, or even lose money. There's actually situations where you could buy a put option, you could get the direction right, and you could still lose money. So long put options are kind of the default position for people. They think, oh, well, that's what I'm going to do. I think it's going to go down, and put options means down, so there you go. But just remember that options involve, price, time, volatility, multiple different factors. So not a very good way to trade. The fourth one, vertical put options. So for this one, now we're starting to get into something that I would say, this is pretty decent, right? If you were going to do something, let's say 34 days out, you could do 69 days out, the 21st of May, but let's just use this one. If you did something like a vertical put spread, something like let's do 2018, see what that looks like, paying just under $1. So it's basically a 50-50 trade. This is pretty good. And the reason why this would be good is directionally, it is going to profit if the VIX goes back down. But secondly, you can see a vertical spread, of course, is comprised of both a short and a long strike. So you're dealing with something that is largely offsetting that Vega headwind. And so whenever you're trading options during high volatility, you want to either be short the Vega and actually be selling premium, or if you're going to be buying something like this, just make sure that the option spread you're using has both longs and shorts in it, so you're not actually having to overcome that massive Vega headwind. And then the last thing that I will mention is a lot of people get caught in their head of thinking that you have to let options get close or actually expire. They think, well, 16th of April, I don't want to wait that long. If you look at this trade, here's the price right now, right? And remember, VIX options settle to VIX futures, so this might not track exactly with what your computer says the VIX is at. But right now, just under 24, this thing could actually deflate pretty quickly. Like if the market decline or goes up, let's say it goes up 4 or 5% in the next 3 or 4 days, something like that, the VIX could easily get back below 20, right? That front month VIX future could be below 20 pretty soon. And if that's the case, you could make half your premium very quickly. So don't always assume that you have to be really strict with the expiration cycles that you do. You could even go stretch it out 69 days. It doesn't mean you have to keep the contract open for 70 days. You certainly don't. You could close it next week and make half your money if it goes well. So don't overlook the aspect of put options, having longs and shorts. There's no Vega problem here, and they can actually profit quite quickly. Next thing that I will talk about is if you just wanted a pure volatility play, there is always nothing wrong with just using the volatility ETFs directly, right? This is with options trading. It does involve an extra layer of experience because you're dealing with multiple different factors that are working against each other. But if you just want a pure volatility play, SVXY, SVIX, these are fine. You could do that. Now, just remember that recently, the volatility ETFs are kind of struggling. And so we'll pull up the SVIX. You can see here in the last year or so, volatility ETPs themselves have really been grinding their wheels. They're having a difficult time launching. You can see the SPY, not so much, right? Aside from the recent crash, but volatility ETPs starting last July have just been massively underperforming. So this is a function of, like I pointed out before, obviously these are more pure volatility plays. And when you have a year where there's 4 massive spikes, this is going to be a problem, right? Remember, drawdowns are more costly than gains are beneficial. So if you're doing something that is spinning its wheels, it's going to have a difficult time getting back to that all-time high. So just be aware that now, although this is fine, it's a pure volatility play, and you can't get into too much trouble, right? You own this thing. That's not unlimited loss. And for anybody who's wondering, Volpocalypse probably won't happen again. I do have a video on the YouTube channel. If you go over there, I did launch a new video today, so check that one out. It's this one here. But if you want to know why Volpocalypse won't happen again, I did this video. It essentially explains 4 or 5 reasons why you don't really have to worry about that anymore. The other thing that I will point out, though, really quickly, people don't know this, but a lot of people think that the SVIX is just way better than the SVXY simply because it's a -1 times exposure, so it's basically double the SVXY. People think that, oh, it's half watered down. Nobody uses the SVXY. Well, if you look at what's happening, yes, it's true that the return in good times is half as much, but it also means the drawdown in bad times is half as much. So it's actually a very good risk-reward ratio, and long-term, they do about the same. If there's a big crash, SVIX will dip down below SVXY. If there's an extended period of really good performance, like 2017, for example, yeah, sure, the 1 times will definitely do better. But just remember that if you are going to do this, there's nothing wrong with actually using the watered down SVXY. It is just as good. So don't let people convince you that it's not a good product. It really, really is. And then the last thing, butterflies. I love butterflies. I'll give you an example of why I like these so much. Let's do VXX this time. Oh no, let's keep it consistent. Let's do VIX. So butterfly options are good because of what I talked about. They do involve both a long and a short, so that's good. We're not walking into a big Vega headwind here. Butterfly options look like this. Now I'm going to stretch that out because that's a tiny little sliver. Let's do the 18, 20, 16. Let's see what that one looks like. So this is pretty good. Okay, here we go with the butterfly. So here's the lower break even. Here's the higher break even. and right here is the price. So this is good. Right here, this is fine, because remember, we are playing for the VIX to fade back down, and it could very easily get below 20. Now, to get down here to 16 or something below that, that's a stretch, right? There is definitely some serious damage to this market. And even if it does drop down, I wouldn't slide all your chips in that it's going to keep going all the way down to 15 or something. So this is fine. But butterflies are really cool because you can easily adapt them by breaking the wing. So let's say, for example, instead of this 20, you moved it to 21. This would be for a person who's very, very sure that volatility is going to decline. You can actually shift some of the risk here down to here. This is a person who does not think the VIX will be here, for very long, but it could actually go quite low. You can see this broken wing. You still keep your middle profit range, but you get to choose which side of the trade you throw that risk on. So then we can move that back, and let's say we moved this to 19. Or that's a fine trade as well, but let's just see what this one looks like here. So if you move that one to 15, now this would be for a person who's reasonably sure the VIX is going to decline, but you're not convinced. And so basically you just want to take a small loss if you're wrong. You're basically only risking $43 over here. But over here, you could, if you nailed it, you're not going to get the peak of it, of course, but potential payoff of $156. So you can make multiples on your money doing these things. And then again, this would be for a person who thinks, you know what, going below 16 is probably not in the cards. And for me personally, I like trades like this because I am not the type of person that tries to roll the dice and make the maximum amount of profit. Like I said, I've got 15 strategies going. I don't need to do that. But I'm a risk manager, right? I'm not an aggressive trader. I consider myself a risk manager. So if you're in a situation where you can actually do something like this, where you can throw on a little trade that could potentially be a much bigger trade, and you're really not risking very much, this is fine. Plus, if it did go back down below 16, this is one of those things that I usually recommend people trade option strategies totally independent of everything else you do. So you wouldn't actually try to fit them all in there like this. But technically speaking, if the VIX did go to 15, I'm quite sure you've got plenty of things in your portfolio that would do well in that environment. You've probably got plenty of net long market exposure, probably do have some net short vol exposure. So that's a really good trade if you think it's probably going to go down. I might be wrong, and maybe over the weekend Trump says something crazy and it shoots up. That's a very good trade. And look, if you lose, if the VIX is 15 next week or in 2 weeks, yeah, we'll probably all have made money in that process anyway. So I always like the broken wing butterfly favoring the, shifting the risk all the way to the far low side on the VIX, because it's not very likely that it's going to get below 16. And that's it. Remember, just stick to those rules. Just when in doubt, extend your duration. When in doubt, trade smaller than you think. Keep it, limited, defined risk. Don't ever do the unlimited loss type things. Not only is it super risky and crazy, but it's just simply too capital inefficient. And you should be fine. Now, I don't know what's going to happen, of course. None of this was trade recommendations. What is the market doing? Up 0.7, so it's kind of recovering. I wouldn't hold my breath. I think things are pretty dangerous. Yeah. Let's get to some of these questions. Let's see what people are thinking. What kind of trades you guys are thinking of slapping on here? I've got a few. I shorted a Tesla put. I shorted some MicroStrategies puts. Those all seem to be fairly decent as long as the market cooperates here. Yeah, a lot of short vol trades, little things here and there. We dipped a toe in long volatility in one of our strategies. It's been fun. It's been a good time. Okay, first question. Not really a question. You have a new PM, Prime Minister. Yeah, I am Canadian, and yes, we do have one. I'm just not so sure he's new. The jury's still out on that one. We'll see. I think he's a little bit too similar to what we've been doing, and we'll see. As you know, I don't live in Canada anymore. I haven't for over 20 years, but I still care about it. It's a beautiful country, and I wish that they would find more active ways to fix it, because it could be great. Let's make Canada great again. Forget America. Let's make Canada great again. Okay. whenever the market is going down enough, some big market participants have to sell to risk off. When they sell, the market is going down more than it should go down because of this forced selling. It says one of two, and I don't see a second one. So that could just be my software. Remember, it doesn't always show me every single question. So I'll just take this as a standalone question. You are right that sometimes it can just sort of build on itself, but I wouldn't count on that because, of course, as soon as the market deems something positive happening, it's going to bounce. You got to remember that when volatility gets this high, the burden is on the stock market to continue to act crazy. As soon as it normalizes, there's no reason volatility should be in the 20s anymore, and it's going to come down. So the market is looking for a reason for volatility to come down. And the only way it's not going to come down is if the market continues day after day proving that it should be priced high, that volatility, there's a reason justifying people's fear. So I don't really like the VIX index as a metric. I don't use it for very much. But if you're not sure what the VIX actually is, it is essentially just a measure of, it's a 30-day volatility measure, but it's an annualized number. So VIX of 24 right now, that means that the market is pricing in plus or minus one standard deviation that the S&P will move plus or minus 24% in the next year. It's calculated off 30-day S&P 500 options. So a VIX of 16, for example, you can just divide, there's 252 trading days in a year, divide by the square root of 252, 15.87. A VIX of 16 means that the S&P is moving around plus or minus 1% per day. So a VIX of 24, we're getting in that 1.5% range daily moves. If that's not happening, volatility will come down because right now volatility is pricing in some really strong S&P moves day in and day out. Remember, plus minus, so up counts as well. But if the market starts to have more of these days where it's just up 20, down 0.3, up 0.4, volatility is coming down. And this sort of self-fulfilling prophecy that you're talking about here, that caves quickly to the upside. So remember, the market is looking for a reason to bounce. How do you manage emotions while trading or when things go south? Psychology, it's fundamental for trading. I agree with that trading psychology is pretty much just as important as anything else. How do I manage it? Well, it definitely helps to have an organized plan, right? This goes back to my professional golfing days. I used to be a pro golfer. I retired 20 years ago. But the one thing that we used to focus, or that I used to focus a lot on, is to have a pre-shot routine, to have a game plan, to have a strategy beforehand, and you don't deviate from it. So you just go into your round. I sit in the clubhouse in the morning. I do my stretching. I do all that, do a little meditation, and then I make a game plan and I stick to it. And then when I'm out on the course, I have a pre-shot routine. Take the same number of steps. I throw this, throw grass on every shot, even if it's not windy. It's just part of the routine. When I step towards the ball, I step with my left foot. I go in with the right. What this does is no matter what happens in that round, I am doing the same things and I'm not making mistakes. So golf tournaments are 4 rounds starting on Thursday to Sunday. Your adrenaline and your fear and your nerves is much stronger on Sunday afternoon than it is on Thursday. But it's extremely important to do the same things and to have routines and systems in place that you don't deviate from. So this is a long way of saying I do the exact same thing in my trading. It's one of the reasons why I think pro golf transferred quite well to investing. I do the same thing. I have strategies and systems that I do not deviate from. I log into my computer the same time, get all the volatility data, input it all, the trend following strategy, spit out the trade for the day. I just take it. I no emotions. Oh, it says move into gold. So I bought gold today. It just said move into gold, safety position. Cool, I'm in gold. I don't do a lot of discretionary trading. And even my option trading that is discretionary, there are tons of systems in place to make sure that I'm doing the right things. Allocation sizing, stop losses, all these things. So what I would say is emotions can largely be contained by just having systems and rules and processes that you don't deviate from. whether it's a good day in the market, whether it's a bad day in the market, whether I'm down money, like let's say 2022 was rough. We had a large drawdown. It was my first losing year in, 15 years. It was not fun. But even when I was in the drawdown, I was still doing the same thing every day. I didn't deviate from it. I didn't say, well, this isn't working. I'm packing up and leaving. I'm going to do something else. This is crazy. I didn't do that. I stick to my system, stick to the data, and got through it just fine and recovered all the money, and we're good to go. I would say that above all else, just make sure that you're not the type of person that flips open your computer and just says, okay, what do I feel today? That is a terrible way to trade. So systems, pre-shot routines. In your strategies, just a second. In your strategies during times of high volatility, is it okay to substitute VIXM and VXZ interchangeably? Some accounts only allow ETF or ETN. So yes, good question. The only reason that I have both of them listed, as you would probably have noticed, is because different people are trading different strategies, and I just put two different tickers for the strategy. So tactical volatility uses VXZ, and strategic tail risk uses VIXM. But your question, because these are materially identical, basically ETF versus ETN, but they move the same, right? These are midterm, long volatility products that, tick for tick are extremely close. So yes, you can use them interchangeably. Now, one of them's an ETF and one of them's an ETN. So as far as like tax filings, K-1 forms, things like this, your specific situation, you might have to go and use the same ticker in both strategies. And that would be just fine. Like, there's nothing wrong with doing that. I just think that, just to keep everything consistent, we're using different ETFs. But if you don't like the VIXM, for example, or you don't like the VXZ, or perhaps your broker doesn't allow it to be traded, well, no problem. Just use the same ticker in both of them and just keep track of the shares. It's really not that difficult. But I just do that for, consistency through the email. But yes, they are materially identical. And you can also do the same thing. Wait, hold up a second. This one. You can also do the same thing with SVXY and SVIX, right? They're pretty close. And while there is a slight difference there, to be honest, you can use both of them if you wanted. So you would just do half SVIX or 1 times SVXY. There are people who perhaps can't use the SVXY. I'm looking for a spreadsheet that might show something here. That's not it. My spreadsheets are sometimes confusing because they're so long, but there is a little bit of a bleed there. But again, materially the same thing. So yes, you can always make these substitutions. A lot of times the ETFs that we're using, it is just for the general consistency throughout the strategies. Like, for example, the SPY. I don't have a problem with somebody using a Vanguard stock market product. We use the XLU utilities. If you really prefer VPU, go ahead. It's different banks, same product, same thing, just, slight variations on the very margins. But yeah, there's a lot of interchangeability, and that's one of the major ones, that just use the one that you're allowed to use. For me personally, it doesn't matter. I'm kind of out of the country. I use international accounts. So do what you need. Do what you need to do. Risk, it's the product of 3 factors, probs. Exposure and impact. You can always leverage one, but just one to be somewhat sound. I gotta say, I don't know what that refers to. But I do like when people are chatting amongst themselves, like in the chat, talk to each other. Perhaps that's what's going on with that question. Remember, we don't insult each other in the chat. That's one of my rules. It's very, very few ways that you can get banned. I've never used a moderator. I don't block people, but that is one thing. Don't curse other people out in the chat. All right. In Germany, we have a trader on Twitter which collected 3 million total for his strategy to short the VIX when it recently went up. The strategy failed, but he says he's still believing in it. And there's a link. It doesn't show the link for me. Is there a question there? Okay. I'm fine with that. The only thing that I will say is you got to be a little bit wary of people who make these types of claims, because what's oftentimes happening, and I'm not saying that this German guy is one of them, but what is often happening is people are highlighting the trades that went well, and they're not highlighting the other ones. So for example, the famous VIX 50-cent trader, right? The famous VIX call buyer guy. Well, unless you're in the room with that guy when he's making the trade, you don't know whether those VIX calls were a speculative position, that he actually did time it perfectly and make some money, or that could just be hedging against a massive net long equities portfolio. And so if you had a big portfolio, again, not saying this German guy, but let's say you've got a portfolio with a bunch of different things going on inside it, you could just show people your hedges when they worked. But that also means that your portfolio got killed. You just didn't show that on Twitter. Or your portfolio is doing extremely well, so you show that on Twitter. You don't show people the hedges that lost a bunch of money, right, and bled your capital. So there are ways to show people only what you want them to see. So unless you're in the room and you've actually audited this, I don't know how you would ever prove something like this, even if he could show you a screenshot of the calls that he bought that actually did make money. Like I said, he could just very easily not show you all the other things that lost money. Portfolio could have been down for all I know. I've been following some person I really don't like on Twitter, just seeing a few of their posts, and they're selling premium. And they're doing something that is unbelievably appalling to me. They are calculating performance based on how much premium they sold. So let's say you sell a naked put option and you bring in $5,000 of premium. Apparently that's considered profit, right? Forget about what the underlying position did. Forget about what it actually did on your portfolio. They're literally calculating performance based on, I sold $250,000 this year of premium. I made $250,000. Nope, that's not how it works at all right? But this is just what people do on Twitter. So you got to be very careful. It's very, very easy to only show the best trades in an account. Same with Instagram. It's very easy to show the best 5 minutes of your day. And then, does that say the rest of your day is firing on all cylinders? Probably not, very easy. So I wouldn't put too much stock in things like that. All right, how would the tactical work over time if one would not take the long vol trade? That's a good question. So I put out a video today, actually. Hopefully people go watch it. But I was talking about how during a market crash, this strategy can actually double its value in the market crash. So the reason that I do like to have this little sliver of long volatility here is it doesn't trigger very often. It's actually less than 2% of trading days that we're in long vol. But when it triggers, it means that volatility is in the upper, say, 97, 98th percentile. And at that point, the market's probably down about 7 or 8%, right? We got the long vol signal right about there. The market's probably down about 5 to 10% when we get the signal. Now, most of the time, the market's going to bounce. But there will be that one time, once every 5 years, once every 10 years, that it's going to go from, 7% down to 20% down, and then to 30, 35, maybe 50 or 55 if it's an actual extended recession. That's why we use long volatility. But to give you an idea for this strategy specifically, the live trading results since we launched in January 2012, don't hold me to these numbers to the decimal places, but basically, this strategy has made about 34% a year, annualized return. Now, 6% of that is coming from gold, and about 6% of that is coming from long vol. And so that would mean about 22% is coming from the short vol. So your question was, how bad would it be if you just stayed in cash? Well, technically speaking, you'd make, instead of 34, you'd make about 28. The only thing I will say is, it's been an entire bull market since I launched VTS. So I am expecting at some point in the future that I'm going to get paid for that aspect of my strategy. There's going to be some devastating market crash at some point in the next, call it 10 years, maybe this year, but maybe 10 years from now. But I'm expecting to get paid a little bit on that. So I can't say for sure that, you'll only lose 6%. You might lose less, like there's no saying that that would even make any money, but I'm expecting it to. It's part of the strategy for a reason. And so I could say that during a bull market, being in cash is just fine. I don't think you're giving up a whole lot, but I know for me personally, and that's what today's video was about on the YouTube channel. Can I just plug it real quick? Because I actually had I had a somewhat viral video here a couple days ago. 13,000 views for me in one day. That's a lot. That's definitely a lot. This one here, how to thrive in a market crash. That's what that video is about. That there is going to be a time when everybody else in the world their portfolio's cratering and everybody's just panicking like crazy. And we're going to be the ones that are sitting there in safety, hopefully in a little bit of long vol, actually making money. And it's going to feel pretty amazing. Like, there's no doubt that we've done well during this bull market. I'm perfectly happy with our results. We've crushed the market, all good. But there's that plus minus gap that you can add during a recession. I think personally that's the real key to long-term survival, because look, I'm not young, I'm 50, but I've still got more time to invest. And I know some of you still have 20 or 30 years to go. It's not always going to be bull markets, but that plus minus gap during bear markets can really accelerate us. So half position, maybe? I mean, is there a reason why? Maybe shoot me an email and we can talk about it. I won't give you any direct advice, but maybe a half position. We already, remember, use the VXZ and the VIXM, which are already slower moving long vol products. These are not highly leveraged things. They move slow. We're talking about making 100% during a recession, something like that. Cutting that in half, maybe. That would be fine. If you have the capital, would you advise keeping the GLD and just add VIXM, VXZ? So you'd be going rogue against the signals. So first of all, I can't give out any direct advice. I can just tell you what I do. Remember, VTS, all this is just my own capital. I don't do anything for marketing purposes. Everything that you see in my emails is literally where my capital is. So I can't make any recommendations, but you're even deviating away from what I've listed for my capital. So could you hold both of these at the same time? Yeah, sure. I can't tell you no, but the signal is to move back into gold. The signal flashed long vol yesterday. We gave it a shot. This is typically the range where the market is going to either fully crater or recover. A 7% correction is pretty normal, but to get into the 12, 13 range, it takes a little bit extra here. So this is kind of right in the range where we're going to get our first long vol signal. And we took a shot, and I don't think it barely lost anything, but we were in and out in a day. And now we're back into gold. Let's just check what gold's doing. Hopefully it's up. Yeah, gold's doing fine. So that worked out. Yeah, everything's all good. If you were to stick to both of them, like you said, sure, but that would be an additional trade layer that you are adding that I am personally not in my own portfolio. Also, how do you deal with poor liquidity in volatility ETFs? Good question. Imagine getting assigned and the ETF opening at gap up or gap down. So the thing about the vol ETPs is oftentimes it does appear like the bid-ask spreads are huge, the liquidity is very low. They're $50 million products. Now, if you are trying to push a major amount of money through them, you might have an issue. But what I find is there's a couple of layers here. First of all, it's not difficult to get somewhere near the mid price. That's the one thing. So even though the bid-ask sometimes looks a little wide, the volatility ETP market isn't exactly the same as just every other stock. Liquidity means a little bit different in the vol space because some of the ETFs, can create and redeem shares, and the market makers, maybe there's a wide bid-ask spread, but the mid price is available. I've never had a problem. I can tell you that. And the second thing that I would say is the only times we ever trade the long volatility ETFs that do have slightly lower volume, the volume ramps up when we're trading it, right? If the market's super calm and volatility is low, that's what's reflecting the overall volume. But right now, because the market's cratering, the volume ramps up during this period. So we're actually buying them when they're their most liquid. I'm not saying it's as liquid as VXX, but it's more liquid. And then that's the second layer you can go to. If you really are worried about liquidity, VIXM, VXZ, then you could do a half allocation to VXX, or you could do a 1/3 allocation to UVXY. Both of those are more liquid than VIXM. But, I've never had a problem with it. So this is the cool thing about the volatility ETP space is that they're all based on the same futures, pretty much. So these are all interchangeable, and you're really just switching your exposure. Like you can use VXX and UVXY interchangeably. You could even use UVIX interchangeably. Options, not so much, but you just adjust the deltas and you adjust the exposure. So we've got about 5 or 6 products to spread it all around, and you just do what you can in your account, your country, your regulations that apply to you. Europeans, you're probably out of luck, but just do what you can. All right, why you took gold trust as uncertainty asset in your dynamic vol trade and not the silver trust. Silver has orders of magnitude more use and intrinsic value than gold. So while I'm talking through this, you know what would be awesome? Every time I do this, I go to my website. This is how bad I am at managing sort of the air quotes business of what I do. I'm a trader. I just do what I can to communicate as best I can, but I'm not an educator. I'm not a business owner. I'm not building strategies to market to the public. I'm just recording my portfolio. That's essentially what VTS is. It started that way. It's still that way today. So I suck at this. And every time I go to my own website to try to find an article that I know I did, gold versus silver in tactical volatility, I remember that article. But for some reason, I'm so bad at this that I label them so poorly, I sometimes can't find them. So can silver be used instead of gold for tactical investing? Good question. So here we go. Because these are tactical strategies, right? It's 100% rules-based. I am able at any time to just switch out the ETFs. If anybody wants to see, hey, what would it look like instead of short vol? You just did SPY, or what if you did something else? You did the Dow Jones. I can do that. Gold and silver is the same thing. We can just look at it, right? So I guess that's it. I guess that's the back test. I did remember doing this, and I do know that silver's worse. On a rate of return wise, it's similar, but silver has larger volatility for sure. So that's why we don't do it. But I would say that in general, what you're getting at is usefulness in industry and stuff. Like silver is more useful than gold for sure. You're not wrong about that. But I don't care what the usefulness of it is. Gold is a parking space for capital, right? I'm not even bullish gold today. We moved into the GLD gold position, right? We moved out of long vol and into gold. I'm not bullish gold. This has nothing to do with the ETF gold. This is just parking space for capital when it's too risky to be short vol and it's too soon to be long vol. We need to park capital somewhere. So each of our strategies has a safety position. Utilities. I'm not bullish or bearish utilities. It's just this is a strategy that is mostly the NASDAQ with cash and utilities. This is a strategy, IYR real estate. It's not an analysis of real estate. It's an analysis of volatility and the market in general. So when I moved into gold today, it's just because gold is the best performer as a safety position. It just beats everything else. I've run the numbers for 15 years on every asset class imaginable at every threshold level with every combination of volatility metrics. And gold is just consistently the top two, utilities and gold. It is what it is. Silver's fine-ish, but the drawdowns are larger. And all I care about is how things perform for me when I'm holding them. Buy and hold gold's a disaster, but holding gold when I hold gold, it's very profitable, right? It's what saved the strategy in the last year because SVXY and SVIX are getting cratered and our strategy's up money. So that's only possible if you know how to tactically rotate between them. Otherwise, short vol got murdered in the last, 8 months, but we did not. So good old gold. Thoughts on volley. So So just to get everybody caught up, Volley is basically a VIX competitor. The VIX index is calculated off SPX options, and it's a full strip of options, at the money, in the money, all of that. Whereas the Volley index is calculated on SPY options and only at the money options. So you could certainly make a case that the Volley index, just head-to-head against the VIX, the Volley's probably more useful. And it's the nations. So what they also have is, because the VIX does include in the money, out of the money, the nations indexes, they also have the SDEX and TDEX. So if you were interested in what 3 standard deviations out of the money looks like, they have indexes for those as well. So you could certainly make a case that Volley is better than VIX. The problem is, first mover principle of VIX, there's no possible way to dethrone it. It's just the most widely quoted, the most referenced. Every blog article in the world hashtags VIX. It's here to stay. But at the money options is probably more interesting for option traders. So the Volley's decent, right? One thing that I do that I could probably reference is one of my metrics. I only use it for option trading. It's not for regular trading. But I do the VIX minus Volley residual. Like I said, the Volley, you could incorporate SDEX and TDEX, and you could do all this by itself. But if you just take the VIX minus the Volley, what is this? What does that mean? Well, the VIX is including everything, all strikes. The Volley is only including at the money strikes. So VIX minus Volley is a pretty good snapshot of what's going on out of the money, right? That's essentially how you look at out of the money options in a very simple metric. So I use that. And then if the VIX minus Volley is very high, of course, that means out of the money premium is going to be more expensive than at the money premium. So what would you do? Well, if you were opening an iron condor, for example, that would be a good trade. If the VIX minus Volley residual is super narrow, like basically close to zero, well, that means at the money premium's paying a lot. And maybe instead of an iron condor, you would open a straddle, something like that. If it's really juicy premium on the wings, then maybe you'd use a strangle. It's kind of a way to just get the slightly more efficient option premiums. You should always sell the strikes that have the highest volatility, and you should be buying the strikes that have the relatively cheap volatility. So yeah, Volley's awesome. I like it, but nobody knows about it. Nobody's going to know about it. The VIX is the king. It's never going anywhere. Okay. Why not open every week consistently new iron condors with smaller risk than a modest one once in a while? Good question. The one thing that I have tried to remind people with options trading is nothing on a calendar schedule will ever work. It does not work anymore. The markets are too efficient. It's been 15 years since that type of calendar schedule. I do this once per week. That hasn't worked in over a decade. The markets are too efficient. The players are too advanced at this point. That simply doesn't work. So you need to actually apply an edge. Let me just see if I can pull this up. It's been so long since I've looked. I don't even know if it's even listed anymore. Okay, we got something going here. Is it going to show me the chart? Oh, you guys are staring at my dumb face. What I'm trying to pull up is the Iron Condor Index, and it does not look like the information's available anymore. Let me just try to salvage this. I wonder if it's possible that I have it on this. That would be so convenient, wouldn't it? No, it's a different spreadsheet. I'll just go by memory. But the Iron Condor Index used to be very good. It's basically doing what you're doing. It's selling Iron Condors on a calendar schedule, the same delta, the same, all that stuff. I'll get into the slightly smaller thing, but it used to work. The iron, if you look at CNDR Index and you can find data for it, it used to perform very well. Like in 2000 to 2007, performed great. And then it basically has just been a flat line for 15 years. The reason for that is that options markets are now completely efficient. Not completely, but very efficient, highly competitive. Teams of analysts looking at the options, things like that, that's not going to work anymore. It used to be the case that you could just be a net short seller of vol. And in 2002, that worked great. In 1994, that worked great. That's not going to work at all now. So the reason why we strategically open our iron condors is because I'm trying to apply an edge, trying to use volatility signals to time the entries and exits. That's the only way to make money in the options world. You can no longer just do this and just do something. Oh, I'll sell naked options on VXX every Friday. Just weekly, I'll just do this. Or I'll just churn vertical spreads because I'm going to try to be safer. I'll just do a vertical every Friday, just like clockwork. Well, no, you're going to make your rate of return is expected to be 0% minus trade fees. That's what's going to happen. Anytime you're not applying an actual timing edge, 0% minus trade fees. So if you were to churn iron condors once a week, once a month, same delta, won't make any money. It's just too competitive. Why would that make money? There's no such thing as free money anymore. It just doesn't exist. I like Bitcoin, and in fact had majority of my investment in Bitcoin, but I realize I'm not getting any advantage. It behaves more or less like the market. That's directed directly at me, right? You're just saying that because I'm going to absolutely love that comment. I've been harping on this on Twitter for quite a number of weeks now, but essentially, I think I've flashed it 3 or 4 times. Bitcoin in the last 5 years has tracked triple leveraged equities basically tick for tick. I mean, it is very difficult to find something with as high a correlation as Bitcoin and leveraged equities. And so that question you're saying, I posted just today, in fact, on Twitter. Ask yourself this question if you're holding Bitcoin right now. This is a thought experiment, a litmus test of your exposure. Would you sell your Bitcoin today and buy the same amount of money in triple leveraged equities? That's the question. If your answer is, yes, I would, then fine. Hold your Bitcoin, do what you want. It's your money. If you're really confident in it, do what you want. But if your answer is no, that would be crazy. Who would put a majority of their net worth in triple leveraged equities? You're out of your mind to do that. Well, really? I mean, are you really out of your mind, or is that exactly what you're doing and have been doing for the last 5 years? So this is why I say I'm not telling anybody to sell their Bitcoin. I'm not telling anybody that it's a bad investment. I'm just saying if you have a majority of your money in crypto, you have to understand that you basically have a majority of your money in triple leveraged equities, because the more institutional exposure it gets, the more senators and congressmen, the more the president of the United States wants to make it an official reserve, the more this happens, the more it's going to track equities. It is now just a speculative risk-on asset, no different than stocks. If stocks go up, so will Bitcoin. If stocks go down, doesn't matter how good the news is. Bitcoin's not going up. And you've seen that, right? In the last 2 weeks, there's been an unbelievable amount of incredibly good news. Bitcoin's down. Why? Well, because stocks are down. It's not difficult to understand. You could announce the whole world is making a reserve currency of Bitcoin. It wouldn't make a dent in the price of Bitcoin. It's only going up when the stock market does. So, yeah, like I'm not mad at this. You're actually saying, yeah, you're kind of starting to understand that, sure, 7 years ago, Bitcoiners were part of this movement and part of this really unique thing that it was different and exciting, and it probably did move different than the market. But now that it's being regulated, now that it's got 15 different ETFs on the market, it's got, asset managers recommending allocations to it. You got to remember that they have to cycle out of it just like they cycle out of their leveraged equities. So yeah, unfortunately, Bitcoin started off as something that would have been cool, and boy, I wish I bought it in 2014. But in 2025, it's just leveraged equities. And for me personally, I think I'd be out of my mind if I put a majority of my net worth in leveraged equities. I mean, you like 80% drawdowns? I don't. Never had one, but please no thank you to that. So thinking out loud, if you are planning to enter spreads which expire a few months down the line, would it maybe make sense to sell the short legs earlier than the long legs, basically legging into the trade? I always say flat out no. Because if you think about it rationally, If you were that good at timing the market, then you'd be a millionaire already and you wouldn't be on my live stream, right? So legging in requires you to get it right. And I always make the assumption that if I did rely on my gut instincts, maybe I'm right 55% of the time, 55-45. 50-50 just for easy parlance, but 55-45. I'd like to think I'm slightly smarter than flipping a coin using my gut instincts, but not a whole lot better. So no, I enter and exit spreads as spreads. I never leg in, even for iron condors. I don't do the thing when the iron condor is in trouble. You sell the vertical and you shift it down to the other one. I just either open a new trade layered on top of the previous one, or I close it and take my losses. But I don't leg into anything in option trading because it does require clairvoyance of the market, right? You could just as easily get it wrong. You sell the short first and oops, the market went down first instead of up first. So yeah, I don't have a high level of confidence that legging in will be any better than just trading the spread. What is your view experience on gap filling in higher volatility environment? You mean just like if the markets have some type of gap to fill, something like that? I don't look at technical analysis at all. Like I don't even look at moving averages. I don't even know why these stupid things are on my charts here. This is just default toss settings. No, I don't believe in any of that kind of stuff. If that's what your question is asking. No. I just trade the numbers and that's how long have we been going? Just over an hour. I should cut them at an hour. Yeah. Okay, I should answer this. When I trade a huge amount at market on close time, is there some issues you should worry about? Yeah, I would say, I wouldn't say worry, but you could definitely on certain days get worse fills. I would always do limit orders. Hopefully you're in person. This is so easy for me to say because I'm on my computer literally all day. So easy for me to say. But if you had to use market on close orders, you could. I did it for many, many years with VTS. Like anytime I know because I'm in all different countries as well. And here in Taiwan, right now it's 1 a.m, right? I don't really want to be awake at 4 a.m. to check the close of the market. So there have been plenty of times that I've done market on close. And yeah, sometimes you look back and you think there's just little shenanigans happening there at the end of the market. So I don't think you're ever going to just see this alarming difference in performance, but whenever possible, I would avoid doing that. You do what you do, though. I mean, if you have to, you have to. Or other way around. Oh, yeah, this is the legging in question again. No legging in. For me personally, if you think that you're that good at timing the market, I think you got a strong future and you're going to make, a lot of money. I tend to rely on my systems and rules and stuff like that. I don't try to predict too much. Why not use leveraged gold, basically? Or is that what GLDM? I know there's like U gold and what is the other one? I don't use any other than just 1 times exposure gold. So I don't know what GLDM is. Let's give that a look. What is GLDM? Oh, okay, I know what that is. Yeah. The mini gold, yeah. The M should have given that away. Expense ratio 0.1. I'll look into it. This is a fine question. How much data have we got? How much volume is going through this thing? Net assets, 10 billion. Okay, looking good. Yeah, I'll consider that. Like I said, gold is a parking spot. So if there is something better, then I would certainly be willing to do it. Let me take a picture of that. That's a great question. Thank you. Article coming soon. Are we going to open a wide iron condor soon? Volatility is high, bottom is near. I wouldn't say bottom is near. You had me there at volatility and all this stuff, and then now bottom is near. I don't get into the prediction game. Technical supports and seasonal flows should stop further downside. So the reason that we haven't opened an iron condor, it's one of my rules in the iron condor strategy, is that we don't open trades during strong trends. And this is actually very important. So first of all, let me just do a shameless plug here. I hope I'm logged in so this doesn't take very long. But we're going to take, I have to check to see if I don't know if the live stream quit. My internet's down. I'm just going to talk and assume that there's somebody here listening to me, but it does appear like my internet's down. What I was going to say is we have I think it's about 32 videos, Iron Condor course that people can take. It's like 5-hour long course at VTS that you can take. And one of the rules and one of the videos in that course will talk about avoiding trends. So, almost made that mistake. This is a strong trend, right? This is clearly a strong trend down. If you opened a new Iron Condor here, there's no doubt that you would have good premium. Like you said, volatility is high-ish. It's really not that high. The market hasn't responded really, really strongly to this yet. But the problem with opening it here is if the market bounces strongly, you can get stopped out on an Iron Condor within 3 or 4 days, and it's frustrating. So what I do during strong trends, I just wait for a couple of days of reversal. So let's take a longer chart here, and I'll just give you an example. So you wouldn't open a trade here. You'd see a couple of days of bounce, and that would be a better entry than that bottom tip. It's crashing down here. You'd wait for it to recover, and then that would be your entry, right? This is a strong trend down. Wait for a day or two of bounce and get it to there so that your Iron Condor is slightly closer to the medium-term average. So here, I mean, for example, if the market bounced somewhere into that range, that would be a better entry for an Iron Condor because at least it's closer to the medium-term average. You might buy yourself an extra day or two in case the market strongly bounces, right? That's why we do it. So I'm waiting. The very first opportunity we get where there's just a little bit of a relief rally, I will jump into an Iron Condor. There is free money. Mutual funds expire date, while there is credit risk. CHOP in liquidation, at least here, the NAV includes notional value, unconsolidated. Thing it's just you have to know it. Otherwise, gets liquidated subpar. Okay, so maybe I should revise what I said because you're talking about things that that probably don't beat inflation. There is free money, but it's still losing money because there's very few things that are free money above the inflation rate and interest rates, and these things all kind of move in tandem anyway, at least in the medium term. So maybe your Iron Condor blind strategy just simply because inflation goes up and the markets go up and, you know, premiums do their thing. Maybe you'd do 3% minus trade fees, something like that. But no, there is no such thing as free money. Believe me, if there was free money, the institutions would take it all. So there just isn't. We have to do it the old-fashioned way, which is just be smart and make our money. Can stop loss or take profit percent be an edge in a strategy? It can, yeah. I mean, absolutely. Risk management is the edge. The stop loss itself is not the edge, but I would assume the stop loss's purpose is to not allow your strategy to have a large drawdown. And remember, drawdowns hurt badly. So if you take a drawdown of, say, 50%, just for easy math, you need a 100% rate of return after that just to break even. So if you're talking about stop losses that keeps your drawdown level low, that is definitely an edge. Position sizing, that's an edge. You know, saving money on trade fees, that's an edge. Selling the high strike premium and buying the low strike when you're doing an Iron Condor. Go into the product depth and see in the moment you're trading which one has slightly higher premium and which one has slightly lower. Put your vertical there. These are all edges. Mental edge, right? Not making mistakes in the moment. This is an edge. But as far as just blind trading, no, can't do it. Still here, still with us. Fortunately, the stream is over because this is the last question, at least so far. I checked, and GLDM does not have options. We don't need options. It's just a replacement for the ETF. So if your strategy, yeah, I will run the numbers on that. That's interesting. That's great. I like doing live streams and having homework afterwards. So this was a good question. And there is an article coming. So everybody, please subscribe and hit the like button. And I know there's a few new people here because that video yesterday, at least for me in my tiny little world of volatility trading, it's kind of a viral video. 13,000 views in one day. That was pretty sweet. So I'll try to put out more videos and yeah, check them out. So we'll actually do a live stream pretty soon, I would imagine, maybe even this Friday. So see you, everybody.